Hey everybody, Josh Bennett here with Money Masters, the channel where we help you earn more, keep more, and grow more money. In this video, we're going to be taking a look at a strategy that can save you a lot on taxes because most people don't necessarily consider taxes when they start to invest, and they don't necessarily consider when they have a portfolio which investments should be in which portfolios. And that's actually a big consideration when it comes to taxes. So we're going to take a look at what's called asset location, how it works, and how it can actually save you money on taxes.
So as I mentioned, in this video, we're going to be talking about what's called asset location. So asset location is a great way to minimize your tax bill from year to year. The way most people invest is you have, say, an IRA, then you have a brokerage account, maybe you have a bank account, etc. So here's your IRA. So IRA, and then this is your taxable brokerage and bank, etc. And then maybe you have a Roth over here too. And it's going to be an IRA slash 401k. Okay, so most people just kind of have these different shells of different types of accounts, but they really don't necessarily factor in how those investments should actually be allocated amongst these different accounts. So, for example, you may have stocks and bonds in here. So, you have stocks and bonds, you may have stocks, then some real estate, then you may have some bonds too, but then you may have bonds over here and stocks, etc. So there's no really thought process laid out between what's in this account versus what's in here. They're just kind of thrown. You may just have amounts and you feel like you have to have a diversified portfolio specifically in every account. So what most people don't consider is that you can actually use a portfolio amongst all these accounts and be very tax efficient if you kind of take it in a coordinated fashion. The reason that you want to think of your portfolio as one entire portfolio as opposed to having a portfolio in each separate account is because investments are not created equal from a tax perspective. So, for example, you have very tax efficient vehicles, and then you have very tax inefficient vehicles. So, tax inefficient vehicles may be things like real estate, high yield corporate bonds, et cetera. And the reason they're tax inefficient is because they put out a lot of income. So, for example, you may have one fund of real estate that is pushing out, say, 5+% a year just in income. That income is going to be at your tax rate. So, whatever your tax rate for your just income tax is, that's what that 5% is going to be taxed at. So, that could be 40-50% for some people. So, that's a pretty high tax rate. Whereas then you have things that are just traditional bond funds that are moderately tax efficient, and active stock funds, things that may still generate tax bills, but for example, any dividends or stock sales may be at the capital gains rate, which is 15 or 20%. So you may have 15 or 20% as opposed to, say, 40 or 50% tax rate. So all in all, these are a lot more tax efficient. Same with if you go kind of up the rankings towards more tax efficient vehicles, you have things like municipal bonds, large cap stocks that don't put out a dividend. So, for example, you may have a high growth company that is just purely appreciation, which is going to be at that capital gains rate, and there's no dividends. So, therefore, they're not giving you income that could be taxed at a higher rate. So, all these things factor into what is the investment's tax efficiency. So, for example, as you look at these, something that may be higher income, such as real estate, it may make more sense to have that in a tax sheltered account, such as an IRA or Roth IRA, because then the taxes are relevant. You don't have to worry about taxes in an IRA. So, if you have a real estate investment in that IRA, that income just stays in the IRA, can then be reinvested. And again, you don't have to worry about the taxes. Whereas you can have something like a high growth stock in a investment account, and then as it grows, yes, you have to worry about taxes, but you're worrying about capital gains rate as opposed to income rates, which will ultimately be much higher. So all in all, being very strategic with where your different investments go in your portfolio can be a huge value add to making sure your portfolio in your assets in your portfolio last, and that you're basically not giving Uncle Sam a tip. You want to only pay your fair share. And a lot of people make this mistake by paying more taxes than they necessarily need to by just not being strategic with where they put their investments. So you can have your whole portfolio, your whole net worth grow in a systemized fashion by just considering, where are my assets, how are they taxed, and are they in the best location for their tax rate. Hopefully you found this information really valuable. Again, these simple steps are a mistake a lot of people make in terms of building their portfolio. And there's really intelligent ways to go about thinking through taxes in coordination with the growth in your portfolio to kind of get the best of both worlds, to really give yourself the best shot of really making your assets last through retirement or just building your net worth in general.